Financial Argument. Follow us on YouTube.
Today's guest is John Williams. John has been a private consulting economist for over 30 years. He is a specialist in government economic reporting and is the creator and owner of shadowstats.com. And I am very happy to have him on the X22 Report Spotlight. John, welcome to the Spotlight.
Dave, thank you for having me.
Thank you for being here. And I wanted to start out with the economy, with the job numbers. And we know last Friday they came out, and all over the corporate media they were saying they were terrible. But what's very interesting is that the job numbers brought the unemployment rate down to 4.7%. And my question to you is, how can the job numbers be so bad and the unemployment rate come down to 4.7%?
Well, it's a matter of very bad definition. The unemployment rate is purely a matter of definition. The federal government publishes 6 levels of it. Their unemployment rate 3, they call it U3, is a headline number. That's the one that came down to 4.7%, and that's the one that gets all the headlines. The issue there is that in order to be counted as unemployed in the headline number, you of course have to be unemployed, but you have to have been actively looking for work in the last 4 weeks. If you've been looking for work for a long time and you've sort of given up looking for work, or you haven't looked for work in the last 4 weeks but still want a job, you're no longer in the headline number. You're counted as what they call a discouraged worker. Mm-hmm. And if you're discouraged, the discouraged workers get counted in a broader unemployment measure called U6, where the headline U3 dropped from 5% to 4.7%. The broader U6 measure held at 9.7%. But if you're in the broader measure and you're discouraged for more than a year, they just drop you from that measure. They no longer count you among the any form of the labor force. Here's where this gets a little tricky, perhaps a little counterintuitive. But usually, when you see the unemployment rate drop, the healthy thing, that's when you have an economic recovery, and you see the unemployment rate drop, is that the people who are unemployed are getting jobs. So you see the unemployment rate decline, but you see the number of unemployed people going down, but you'll also see a rise in the employed people. That's a healthy circumstance. What happened with the headline numbers for May was they lost something like 480,000 unemployed. They disappeared from the numbers there, but the number of employed only went up by 26,000. You had a large number of people who left the workforce as counted in U3. Presumably they're now counted as discouraged workers, although that wasn't particularly clear either. There's some very serious quality problems with these numbers. But the key with the big drop in the unemployment here, you go back to the trough of the recession, unemployment, the headline number was at 10%. Now it's down to 4.7%. If the decline in unemployment doesn't go into people with jobs, but rather people dropping out of the labor force, you still get a drop in the unemployment rate. And that's been the bulk of the improvement in the unemployment rate. It's been people dropping out of the labor force, not getting employed. And that's one thing that has the Fed chair, Janet Yellen, concerned, because one of her favorite numbers to look at is what they call the participation rate. That's the ratio of the labor force to the population. And along with that improvement in the unemployment rate on Friday, the participation rate dropped by 0.2 percentage point. It's near an historic low. There's a serious problem here with people not being able to find work and giving up looking for work. And if you go beyond that 1 year, and you'd still like to work, but you can't get a job, the government doesn't count you. I still estimate it. You have to keep in mind here that back in 1994, the government redefined the way it counts unemployment, redefined the questions for the surveys. They used to count people as discouraged workers, irrespective of how long they had been so-called discouraged. Now they don't count them after a year. It was used to be a measure that would pick up the displaced workers, people who'd like to work, but let's say because of NAFTA, a plant was shut down in their town and they couldn't find a place to work and they didn't want to move out of town. If you count it the way it used to be counted and look at the displaced workers there, you're looking at a national unemployment rate that would be probably up around 23%. So that where the headline unemployment rate declined for May, and the broadest government number stayed unchanged, mine went up a notch to 23%, because of increasing burden of the displaced workers.
So with an unemployment rate from your calculations at around 23%, wouldn't you say that we're kind of like in a depression right now?
Well, that's an area that's never been well defined. For depressions, you get euphemisms from the government and its economic reporting. Before the Great Depression, every economic downturn was referred to as a depression. That's because if you plotted the path of economic activity, you'd get a depression, and then it'd come back up and would rise and fall. With the Great Depression, referring to what we call now a recession as a depression, was not politically popular. So that what they did was they redefined the depression. Actually, they didn't redefine it, but used different terms. And for a depression, the downside was referred to a recession. I mean, the economy is receding, and then recovery coming up. So the depression used to be a period of recession and then recovery. Now, that said, I went back and discussed with a number of people what would count as a depression in the post-Great Depression era, something that take you back to that type of a magnitude of a decline that was seen. And general consensus I came up with was sort of a peak-to-trough contraction in excess of 25%. We haven't seen that here, at least not yet. Now, in the Great Depression of the 1930s, the peak unemployment rate was about 25%. And so with mine at 23%, it looks like it's getting pretty close. But back in the 30s, something like 27% of the population, or those who are employed, lived and worked on farms. Today, that's less than 2%. So if you looked at the non-farm unemployment rate back in the Great Depression, that was about 35%. I think that'd be more comparable to my number. I think what we're seeing now is basically it's probably the worst we've had since the Great Depression, but we also had some pretty bad times back in the early 1980s, in particular, back in 1975. So we certainly have seen from the standpoint of economic activity, we've seen the worst economic activity since the Great Depression. We're not quite there yet with the actual unemployment.
Do you think the economy right now is in serious trouble?
Of course it is. It never recovered. I mean, we've seen the deepest decline in economic activity again since the Great Depression. If you follow the headline number, the official numbers, which are very heavily gimmicked, show that the economy started turning down in 2007, plunged through 2008 into the middle of 2009, and then recovered. Just went higher And the GDP, the biggest, the broadest measure that they have of our economy right now is adjusted for inflation is 10% above the pre-recession peak. That's nonsense. If the GDP were 10% above the pre-recession peak, nobody would be debating whether or not we were in a recovery or what was happening with the economy. That would be good news. What I'll contend, and I can show with a number of indicators, is that the economy, yes, indeed, it probably peaked back in 2006. It really started to plunge toward the end of 2007, hit a trough in 2009. That far, my numbers would go along with the government. But where you may have had some bounce off the depth of the trough, you never had a recovery. You just had a period of low-level stagnation in most areas. You can see that in virtually all the housing and construction numbers. If you look at the plots there, they never recovered. They're just bouncing along at relatively low levels of activity, maybe a little uptrend, but they're still anywhere from 30 to 70% below the pre-recession peaks. You look at freight activity, which is a broad measure of economic activity, and you'll see a similar pattern: plunge, little bounce, and then low-level stagnation. And all the numbers are beginning to turn down again. You do see numbers like the GDP and real retail sales and even industrial production that actually reached the pre-recession levels, and there's some reasons for that. But consider that even as published, the industrial production now has fallen back below its pre-recession peak, and the manufacturing sector never recovered its pre-recession peak. There's a problem with the way the government handles inflation. They've changed methodology there a number of different ways over the last couple of decades, and the effect has been to understate inflation. It's been very deliberate. You go back to the 1990s, people who were following what was going on at that time might remember conversations from or points made by Alan Greenspan, who's Fed chairman, or Michael Boskin, who's head of the Council of Economic Advisors, putting out a story. The CPI inflation overstates inflation, and if only we had a more realistic number, a lower inflation number, that would help us with the budget deficit, because we could cut back on cost of living adjustments to Social Security, and the lower inflation would also tend to boost people into higher tax brackets, so they'd get more tax revenues. And what they did was actually altered the method of calculating the CPI to gimmick it in the government's favor, where many people rely upon the government's inflation numbers as a meaningful measure of what inflation is. Let me just tell you briefly what they did, because this has major impact on the economic reporting and why you don't see what's really happening in some of these numbers. Going back a couple of centuries, and there have been consumer price indices that have go back a couple of hundred years. The concept behind the consumer price index, at least for most people, is from the standpoint of looking at, my income. Is my income going up fast enough to at least stay ahead of inflation? Or my investments, am I getting enough of a return so that I'm staying ahead of inflation? The way inflation was looked at there was as a measure of inflation in maintaining a constant standard of living. Very simply put, they'd say take a pound of beef, a gallon of gas, loaf of bread. They'd price that basket of goods out 1 year. They'd then price out that exact same basket of goods the next year, and however much the price had changed, that was a rate of inflation, a rate of annual inflation. If you ask Greenspan, what do you mean the CPI is overstates inflation? Well, he said, if steak gets more expensive, They're too expensive. Consumers are going to buy chicken or hamburger instead of steak, and their costs will be less unless their cost of living isn't as high. Well, while that might be true from a certain definition of cost of living, that's not the case in terms of what's needed to maintain a constant standard of living. The idea of a constant standard of living is that your income is increasing with inflation, so that you don't have to switch from steak to hamburger in order to live. That was the whole concept behind the CPI. But the government wanted to move towards a substitution-based index that would reduce the low. They did that. They also introduced what they call hedonic quality adjustments. Now, very common that the government, and quite properly, would adjust for quality with certain measures in the consumer price index. They have people who go around and survey costs of goods in stores all over the country. And what they might find is an 8-ounce candy bar. And 1 month, it's a certain size package and certain price. Let's say the next month it's the same size package, but they've reduced the size of the candy bar to 6 ounces. You'll find that happens. In theory, they pick that up and they make a mathematical adjustment so that it reflects the actual cost of the candy that you're getting. That's a legitimate adjustment. But then they'll say, we have quality adjustments here that are taking place in things that people don't recognize or that they have no way of quantifying, and they have computer models that will estimate what the saving is, and they deduct that from the rate of inflation. In an extreme case, this was some years back, the government mandated a change in formulation of gasoline to help with emissions. When it went into effect, it had the effect of boosting the consumer price index. Well, it had the effect of boosting the price of gasoline by 10 cents a gallon, which at the time was a significant amount. It did not get reflected in the consumer price index because the government deemed that to be a quality improvement. The average guy who's pumping up his gas into his car to go to work was moaning and groaning about having to pay more for the gasoline as opposed to as opposed to what the government was indicating he wasn't paying. He wasn't thinking about the better atmosphere. He was thinking about out-of-pocket expense. The CPI as we know it today does not reflect a constant measuring the cost of maintaining a constant standard of living, and it does not reflect the cost of out-of-pocket expenses. Now, how this affects the economy, and in terms of aggregate change here over time, somewhere between 3.5 and 7.5 percentage points on an annual basis. I mean, when they're looking at inflation right now, that's about 1%. You're looking at something that in reality most people would think would be over 4%, if not more. But here's the trick with economic statistics. Most of the numbers, things such as the GDP or retail sales, get viewed net of inflation. If your retail sales are up 10%, you're the retailer, say, hopefully that's good news. But then if you go look and you see that that's because inflation was up 15%, you actually lost 5% in your real sales, that's not such good news. So they tend to deflate the dollar numbers by inflation. And if you understate the inflation, the resulting inflation-adjusted growth is overstated. In terms of the gross domestic product, that's overstated. As best I can estimate it, the inflation there is overstated by about 2 percentage points. If you take that out of the GDP numbers, along with over the period of time where the methodologies were changed, what you'll find is that the economy plunged into 2007, and then basically has been stagnant ever since, flat and never recovered. Same thing with retail sales. And even with industrial production, there are components there that are still inflation adjusted, although it's an index, show the same pattern. Adjusted for overstatement of inflation, you see most series will tend to confirm that a pattern of non-recovery. And what's frightening now, unfortunately, is that the economy is turning down again. It never recovered, and now it's turning to the downside.
Now, since the economy is turning to the downside now, and we're really not seeing an improvement from what you're saying, why is the Fed pushing interest rate hikes? Why at this point are they saying, okay, it looks like now is the time, and they keep talking about it? Why at this point are they pushing so hard to raise the interest rates?
Well, they don't know what to do. They're in real trouble. The system collapsed effectively back in 2008, and they've been stymied ever since. What they're trying to do with talking up the interest rates is to keep the dollar strong, because if the dollar weakens and you get excessive selling of the treasuries, and the dollar weakening very sharply, you're going to see a big pickup of inflation, which is where we're heading.
So you think
I'm sorry.
You think the dollar is going to devalue?
Collapse, yes. If you go back to the panic of 2008, there's a point in time there where if you're listening to the headline news, you'd see the Treasury Secretary or the Fed Chairman say, we've got to put together this package today because if we don't, the system's going to collapse. The bank system's going to collapse. They weren't kidding. We should not have gotten to that point. It was a culmination of decades of abusive economic and fiscal policy. But they wouldn't let the system collapse. They're afraid of a 1930s-style banking collapse, which would have been deflationary. Because what happened back in the 30s was as the banks collapsed, people had their money on deposit with the banks, lost their money. And as a result, the money supply collapsed. It's down about a third. The economy was down about a third. They made the decision at that point in time to do whatever they had to do to save the banking system. They were not going to let it collapse. And they did whatever they had to do. They bailed out any entity they had to. They created what cash they needed. They guaranteed all deposits. You look at who was bailed out aside from some of the large banks. The Fed bought AIG, which is the largest insurance company, backing the bankrupt mortgage-backed security system. Whatever area they had to prop up, they did. And the Fed had the ability to create whatever money it wanted. The problem is, although they prevented the system from collapsing, none of the actions they took addressed the underlying fundamental issues. Didn't address the issues as to why we'd gotten to that point in time. The circumstance of the long-term insolvency of the United States. Those were issues that didn't concern them. They just took stopgap measures to buy a little time. They pushed the problems into the future. We're in that future right now. Now, what did the Fed do? The Fed's primary function in life, aside from their official relationship with the government, where they're supposed to keep employment healthy and inflation under control, is to keep the banking system intact. Everything they've done here has been designed to keep the banking system from collapsing. The quantitative easing was never designed to prop up the economy. They don't have the ability to prop up the economy. Bernanke indicated that a number of times. All the cash they created was designed to provide liquidity to the banking system. Had it been designed to go into the normal flow of bank lending into commerce, that would really have helped the economy. But that didn't happen. A lot of people still have problems borrowing money, even with top credit scores. All this was designed that they bought the treasuries being held by the banks, and they told the banks to deposit the cash with the Fed. The Fed paid them money on it. The Fed bought the treasuries. They bought enough treasuries to effectively monetize 3/4 of what the federal government was issuing at that time. They're holding on to those treasuries. They paid the interest on the treasuries back to the U.S. Treasury. They monetized those treasuries. They stopped buying treasuries, but they've maintained the treasuries. They've after a couple of years of threatening to raise rates, which was always used to prop the dollar, that threat was, they actually raised the interest rate, the Fed funds rate, by 1/4 of a point off of zero. And they've been threatening to raise rates ever since, but they can't do it because they're afraid of what's happening to the banking system. It's not that they're afraid of, this is going to hurt the economy. Actually, higher rates would probably help the economy. I know that sounds a little perverse, but it would mean greater lending. People on fixed incomes could get a safe return on their money, assuming it would insured certificates of deposit, things like that. Weak economy, the economy's turning down again means the banks are in trouble. I mean, they've been in trouble all along. This is not going to help them in their recovery. It's probably going to push the Fed back towards some form of quantitative easing. I don't think you're going to see any tightening here, any higher rates until after the election, although they're going to keep talking about it every week. But as the economy gets worse, and a lot of signs that's already happening, and they move back to providing liquidity to the banks and buying the treasuries, effectively funding the U.S. government, that's going to become very inflationary, eventually leading us to a hyperinflation. It's a circumstance I thought would have come to fruition a couple of years back, but I didn't foresee all the things they're going to do to try and prop up the system.
When do you think it's going to happen at this point?
It could break very quickly. It could still be another year or two. I can't give you a firm date on it because it's the things that'll happen that are no one is really planning, but when they happen, they'll be relatively massive and swift, such as the rest of the world deciding to dump the dollar, sell treasuries. You're already beginning to see that. Why would the Fed go in and start monetizing treasuries again? The government needs to borrow the money. Who's it going to borrow it from? I mean, all our big buyers are now generally net sellers, such as China, Japan, Korea, Saudi Arabia. The big net buyers have been the Federal Reserve. And you get massive selling against the dollar. Nobody really wants to hold the dollar. They know the dollar long term is going to become worthless. It's going to be reflected in a rapid rally in precious metals prices and also oil. And the oil spikes gasoline prices, and that'll give you a very early spike in basic inflation. But it'll start the process that's going to move us into an inflationary.
So for those people who don't understand, when you say hyperinflation, what would people experience when hyperinflation hits?
With hyperinflation, the currency becomes worthless. Literally worthless. You want to be holding some hard assets such as gold coins. They'll retain their purchasing value. To give you an example, there are a lot of stories that come out of the Weimar Republic after World War I in Germany, and as the inflation was beginning to get bad, you could go into a restaurant and order dinner one night, have a nice bottle of wine. The next morning, what had been an expensive bottle of wine was worth more as a scrap glass than it had been filled with fine wine the night before. The depreciation of the currency can get so rapid. You look at another extreme case, recent one is in Zimbabwe. If you got paid in Zimbabwe dollars, you immediately ran down to the black market and exchanged it for U.S. dollars. The U.S. dollars to them were they were gold. That was your store of wealth. The dollar becomes worthless, and there are all sorts of things that happen with that. You'll have some warning on it, but as you start to see it pick up, eventually we're headed in that direction. And the reason is that we've lived so far beyond our means that we've effectively doomed ourselves. If you have some people who really wanted to overhaul the system and try and balance it, they might be able to do so. Mm-hmm. It'd be economically painful and politically painful. But here's the big problem. And I've started formally forecasting hyperinflation back in I think it was 2004. It was around it. It was back in the during the Bush administration, the last George Bush administration, when they overhauled the Medicare program. At the time they did that, it was the total federal debt was about $8 trillion. And when they overhauled the Medicare program, they didn't fund it. And they increased unfunded liabilities. And net present value, that means the amount of cash you need in hand today that you could invest that will cover your future obligations was about $8 trillion. So in one fell swoop, they doubled the obligations of the federal government. Today, the total obligations of the federal government, including the debt and the net present value, this is not the total cash outflow, but the amount of cash you need in hand to cover that cash outflow going forward is in excess of $100 trillion. That's more than the global economy. There's no way we can ever possibly cover that out of normal government operations. The way it generally gets handled is that either a country defaults on its debt, which is very unusual, or more commonly, it just if the debt is denominated in its currency, as Alan Greenspan said, the U.S. won't default on its debt because it can print the dollars it needs to pay it. That's exactly what they do. They print the dollars to pay their obligations. But in the process, they have to create so many new dollars that the dollar becomes worthless. It creates the inflation. And that's ultimately where you're heading. But that's not going to be 20 to 30 years down the road. The crisis is going to come when you have the rest of the world dumping, 15, 20 trillion dollars worth of dollars outside the United States, sending them back to the United States, and we've got to absorb it in the system here, and all of a sudden you see the inflation begins to skyrocket.
From all your research and looking at GDP, unemployment, the dollar, when do you think, and a lot of people are saying that the second half of this year that we're not going to make it through, when do you think the system's going to come down?
2008. It's already happened. And the difference here, in 2008, the Fed and the Treasury committed to saving the banking system as opposed to letting it fail. I'm not saying I'd do anything different. I mean, you wouldn't have wanted to see the system with the banking system failing. But at that point, they committed themselves to inflation as opposed to deflation. The people out there looking are saying, the debt's going to collapse. We're going to have deflation. Collapse of debt does not give you deflation. It doesn't contract the money supply. It hurts the banks. The banks can't lend as much money. That's what we've seen. But it's the loss of the banking system that contracts the money supply. So at that point in time, they made the commitment to save the system, but the system at that point effectively was lost. The reason they can't seem to find their way, the reason the rest of the globally central banks can't seem to find their way, is that they don't know what to do. They've never seen anything like this or afraid of a systemic collapse. Now, in terms of the economy, we're still moving along at something of a positive pace, at least according to actually it's not. If you look at the first quarter GDP numbers, it was revised higher to a little over 1% or so, I think it was. But the gross national product, which is a broader measure, it's a GDP. The GDP is the gross national product, net of flows of interest and dividend payments. Mm-hmm. So for net debtor nations, the GNP usually is weaker. That's why we report the GDP. But back in the days of Lyndon Johnson, we used the GNP. The GNP contracted in the first quarter. We've seen contractions already in industrial production. You're going to see a benchmark revision to the GDP, and at the end of the July that'll probably show that we've had several quarters of contracting GDP in the last year or so, and that we've been in a recession since a new recession since December of 2014. In terms of how this goes how long do we go before the dollar starts to fall apart and before people see the headline turmoil in the economic statistics, and you see deteriorating unemployment pictures. We've actually started into that era now. So come the election, I don't think you're going to get through the election without major disruptions to the financial system. The economy certainly is going to be weak, and how it goes after that remains to be seen. But I don't see a happy picture here.
John, I want to thank you for being on the X22 Report Spotlight. Can you just tell people how they can see your work?
Sure. I have a website called shadowstats.com. I sell a subscription newsletter on the website. It's weekly. I also post on the website a number of think pieces that describe how we got where we are, where we're going, hyperinflation report, article on inflation and the employment. We'll publish our alternate measures of inflation and unemployment on the website, available to anyone who just wants to go and look. We always like to pick up new subscribers if anyone's interested, but our subscription fees are reasonably small as things like this go. I mean, $175 a year, $89 for 6 months. But you can read my headlines and get a sense of exactly what I'm looking at and the big articles in terms of the broad picture, and that the broad picture does not change. Those are there for the reading.
John, once again, thank you for being on the Spotlight.
You're most welcome. Thanks for having me.